Hi, and welcome back to Squirrel School. If you're new here, make sure you hit subscribe to never miss our videos on self-managed super funds. Today, we're looking at how your self-managed super fund, or SMSF, is taxed. We promise you'll want to stick around for this. An SMSF is taxed just as though it were a hard-working individual. SMSFs are essentially investors in themselves, but unlike individuals, they're taxed at a flat rate of 15%, compared to the highest marginal tax rate of 45%. That's substantially less. What's more, once you commence a pension from within your fund, your tax rate is reduced to nil. Taxing your SMSF can get complicated as your balance increases. Engage a qualified accountant to be sure you're on the right track. Managing your own super fund gives you control over the fund's tax position. Let's look at how your fund is taxed. Contribution tax. Contributions are either concessional or non-concessional. Concessional contributions are those for which a tax deduction has been claimed. A non-concessional contribution is one made directly from a member's post-tax income into the fund. Now, concessional contributions in the fund are taxed at 15%. Non-concessional contributions in the fund are not taxed, as regular income tax would have already been applied. Income tax. Your SMSF makes money just like you do, so your fund pays tax on its investment income. Once you've commenced a pension though, income from investments within the fund is not taxed. Capital gains tax. Your fund pays capital gains tax on the sale of assets, just like an individual. That rate is 10%, providing the asset has been owned for at least 12 months. Assets held for less than 12 months are taxed at 15%. Capital gains tax in pension phase is 0%. Division 293 tax. This additional tax applies to individuals with an annual income of over $250,000. In a nutshell, it accounts for the larger deduction these high income earners would make when they make concessional contributions. Tax is unavoidable, but be smart with your super fund tax and you can access significant benefits. Let's take a look at some popular tax strategies. Recontribution strategy. When a member draws down on their balance either via a lump sum withdrawal or via a pension stream, they can recontribute that amount as an after-tax contribution. The benefit of doing this is to reduce the amount of tax paid on the super benefit once the member dies. Spouse contribution splitting. A spouse can allocate 85% of their concessional contributions for the financial year to their spouse's fund at the beginning of the following financial year. This can be beneficial if one party is commencing a pension from their SMSF, as they can enjoy the tax-free environment sooner. Attribution of assets. In a fund with multiple members, you can benefit from attributing certain assets to certain members. This is especially beneficial if you have members at varying stages of life. Assets with unrealised capital gains can be attributed to older members that are already in their pension phase, so that when the asset is eventually sold, it isn't liable for capital gains tax. Contribution of assets. Members are able to transfer certain privately owned assets into the fund as a contribution and claim a tax deduction for it. It'll trigger a capital gains tax liability for the member outside of the fund though. Now remember, capital gains tax outside of your SMSF is assessed based on your total income. So if you make a capital gain of $50,000, that is added to all other income you made that year, less any deductions. Asset attribution. John, Maxwell and George are three brothers that are joint members of an SMSF. John is 41, Maxwell is 48 and George is 64. In their super fund, they have several properties among other shares and cash. George will be retiring soon and commencing a pension on his share of the fund. One of their properties has grown in value after a property boom in Melbourne, so the brothers want to sell. To avoid paying capital gains tax, they attribute the asset to George and plan to sell the property once he has commenced his pension. Capital gains tax benefits plus asset contribution. Laura decided to commence an SMSF when she inherited a property from her grandmother, and she contributed the asset worth $300,000 as a non-concessional contribution using the bring forward rule. She leases out the property and enjoys the 15% tax rate on the income. Once she commences a pension, she can sell the property and 0% capital gains tax, or continue leasing it out and pay no tax on the income. Thanks for watching today's Squirrel School on Super Tax. It isn't such a tough nut to crack after all, hey? Now you can take advantage of SMSF tax environments. If you like this video, give it a thumbs up and make sure you subscribe so you never miss anything from Squirrel School.